Hey there, everyone. Happy Monday, November 18th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you not from a rainy Redmond, Washington, but after traveling over to the East Coast from a beautifully cool and dark New York City. Sorry, I'm doing this a little bit later than normal, but the flight arrangements had to come first. So happy to share with you some reaction to today's market activity as the major averages kind of mix today here on Monday. I'm in New York speaking at a couple events for the CMT Association. You may have noticed after my name, the three initials CMT, which stands for Chartered Market Technician. This is an industry association for technical analysts and for financial professionals who use technical analysis as a primary input in their decision making. And this year, and actually November, I believe, is the 20th anniversary of when the SEC approved the CMT designation as an official designation and made the MTA at the time, which was the former name of the CMT Association, named them a self-regulatory organization, an SRO, which is a huge step forward for the technical analysis community within the financial industry. So a number of us coming in town to celebrate that, to do a couple events, and look forward to reconnecting with some of my former New York friends here, or I guess friends that are in New York. That was a horrible way to say that. Sorry, guys. But good to reconnect with people that I used to see a lot more often when I lived in the Northeast, and great to be back here for the week. So, looking at the market today as we get up the dashboard, this was Friday's session with the sell-off, then a bit of the rally. Obviously, last week was pretty painful by any stretch of the imagination. The S&P down over 2% through the course of the week. The real question going into this week, will we see an upside rebound? And we do have some key earnings, including NVDA, now the largest company in the world by market cap, reporting earnings later this week. So there are some potential catalysts. Not a big economic week, to be honest with you. So I think NVIDIA earnings is kind of the big thing I'll be looking for. Some others as well, right? We've got some big box retailers like Walmart and Lowe's reporting on Tuesday. We'll go through all of those charts and a lot more here as we get to the chart review portion of the day. Looking at the S&P, we can see up 0.4% from Friday's close, that is. So we finished today around 58.94. The Dow was actually slightly lower by about 0.1%. The NASDAQ Composite leading the way higher, 0.6%. You can see with most of those, you had a nice rally going into kind of the lunchtime hour here in New York, and then sort of tapering off and drifting lower into the close. Small caps continuing to not get much of a bid, just like the Dow ended up finishing slightly lower. The VIX, while moving up into the mid-teens, and on Friday we actually got all the way up to around 17.5 on the VIX. Monday session here today, kind of back below 16. So anything below 20, in my opinion, sort of a low volatility, safe and sound kind of bull market range for the VIX. Interest rates, of course, quite an area of focus as we think about Fed potential rate cuts at the December meeting and then into the beginning of 2025. Now we're talking a lot about the terminal rate, which is sort of that, if we do have a series of rate cuts, where does the final rate cut get us to? And expectations I'm seeing down in the 3% range. So that means, obviously a couple more cuts lined up. And again, that's the short end of the curve that we're talking about. The 10-year point and the long bond yield have sort of been doing their own thing and sort of been diverging a bit from the direction of the short end of the curve. Today, you actually saw the 10-year point move slightly lower, not too much. We're currently finished today just above 4.4%. The long bond yield sitting above 4.6%. And actually, really importantly, I would say the dollar index actually moving lower, because that leads to the next chart, which is when the dollar moves lower, particularly we've had a stronger dollar, which has been the trend here over the last couple of months. All of a sudden, the dollar moves lower. That allows things like precious metals to move back higher, which is indeed what we observed. Gold up about 2%, silver prices up about 3%, crude oil prices having a decent up day. And that allowed the energy sector to be your top performing sector. Here we are as we record the show evening of Monday, the 18th. You can see cryptocurrencies overall having a decent weekend. Today, Bitcoin price is currently trading just above 90,500. So we spent, Sunday now into Monday, sort of above that 90,000 range. I'm noticing a couple of ticks here over the last 24 hours below that 90,000 level, maybe serving as short-term support here. That's kind of an important one to watch. Ether price is up pretty well, also up almost 4% today. You can see most of the other top 10 coins moving higher. And out of all the things that I just showed you, in terms of disclosures, I definitely own index funds, but none of the ones that I showed you. But I do have exposure to sort of, the general large cap growth space. Bitcoin, Ethereum, the GLD, I do all own in my own accounts. All right, let's look at the 11 S&P sectors. You can see the XLE up 1 1/3%. That's your top performing sector. Communications, services, and consumer discretionary, both up just under 1%. On the downside, only one of the 11 S&P sectors in the red. That's industrials, and again, just slightly below zero. Healthcare and financials rounding out the bottom three. You can see as of Friday, and actually you can't see that because it's updated on today's close, but the short-term model for the Qs actually did turn negative on Friday's close. The rest of these remained bullish on all time frames, and as of today, with the bounce, the Nasdaq just right back to bullish across the board. So as of Friday's close, our main market trend model remained bullish, and when that happens on the multiple time frames, that just basically tells me long and strong. Look for long opportunities and don't be afraid of the trend, because it's generally speaking higher by definition. Looking at the Magnificent Seven and Friends, these mega cap growth stocks, and by the way, last week we did a special video. This was on am I making this up? I think on Stock Charts TV on Friday. No, is that true? No, this was on my own channel here on YouTube. I did a video looking at the Magnificent Seven and actually bucketing them by the type of chart, and really interesting video if you go back there, because I found a lot of times when you have a group of anything, a group of stocks or ETFs, bucketing them or grouping them by certain technical characteristics can help you think about some of the larger themes, larger takeaways, and figure out of a pile of charts what are the actionable ideas. So check that out. It was on my YouTube channel on Friday, I believe, that I posted that video. Today, you have Tesla up 5.6%, Netflix up 2.8%, Alphabet up 1.6% on the downside. Two names lower, NVIDIA, which, as I mentioned, reporting earnings Wednesday this week, down 1.3%. So a bit of a sell-off here going into earnings so far this week. Amazon also down another 0.5%. Now, neither of those are, horrible down days, like things to get worried about. But, the bull case for stocks, I would argue from here, involves names like Amazon and NVIDIA really accelerating back to the upside and renewing those uptrends that have stalled out here in the month of November. So certainly two of the charts I would be very much focused on here. All right, let's get to the market carpet and focus on how things have played out. Before we get to the market carpet and some of those takeaways, I did want to remind you there is still time to sign up for our free webcast coming up tomorrow on Tuesday the 19th. I'll be doing a webcast called From Patterns to Profits, the three-step approach to technical analysis. We'll be talking about how a lot of times I find traders tend to think of technical analysis as a very straightforward sort of singular moment. There's a signal and then that's kind of it. What I'm going to do is sort of go through a series of examples to show you how you want to think of any technical signal, particularly price patterns, as a three-step process. And I'll show you exactly what I mean, what those three steps are. Hopefully by applying those three steps in your own process, you can improve your hit rate or improve your success rate and minimize drawdowns, minimize whipsaws. You can sign up for that free event at marketmisbehavior.com/3 steps, or just scan the QR code that you see on your screen. By the way, if you can't make the webcast live, just make sure you sign up, because I will send out the replay later in the day tomorrow. And as long as you've signed up, I will make sure that you get the replay to your email. All right, let's look at the market carpet here. And as you can see, generally speaking, first approach is to look at the overall takeaways. What sort of big takeaways do we notice? Generally speaking, kind of a mixed day, but I'm definitely feeling more green than red, I would say generally. I would, certainly identifying some of these big red items that are popping out. That's certainly one of the takeaways for me, which we'll look at at a little later. But overall, I would say, generally speaking, kind of a bit mixed, but skewing more positive. I would particularly note the strength in the technology sector in certain areas, particularly some of the semiconductor names like AMD, which have been struggling as of late. Second, we look at the big dogs, the biggest charts. You can notice NVIDIA, a bit of an outlier, down today. Eli Lilly, while not one of the Magnificent Seven, it's certainly the biggest healthcare stock here listed in the U.S., down 2.5%, which is a bit of a concern. Over here, Tesla, of course, up almost 6%. That's your top performer, one of the best, biggest gainers in the S&P 500. Finally, let's look at some of the outliers. I would point out in particular in the consumer discretionary sector, things like VF Corp down almost 3%. And that's a stock that's actually stalled out after breaking out to a new high, up to $22 a share after coming back. And today getting back below 20, which is an interesting sort of big round number to focus on. Best Buy down about 4%. That's a stock that stalled out at big round number resistance at $100 a share, currently about 10% below that. And Ulta, which is one of those charts that's not been a particular strong chart, but it's tried a number of times to get above 400 just recently here earlier in the month of November. Looks like it might have been regaining momentum to try to make a run to get above resistance at 400. Not doing so currently. It finished today just around 350 or so, and that's actually down another 3+% from yesterday's close, from Friday's close, that is. All right, let's go to the chart review and focus on how the charts evolved. So the S&P, Friday we had the gap lower below trendline support. I'm not super keen on that trend line necessarily anymore, only because we've gapped around it. It's not sort of a pure trend line, unbroken trend line now. It's sort of vulnerable, I would say. On Friday, we actually traded right down to the October resistance, right? The October breakout point and the upper end of this price gap. And price gaps for me, I often think of them as just support and resistance ranges. So sort of this range from around 50, we'll call it 57.80 up to around 58.70 or so, sort of this range, kind of a key level to watch. So Friday, we gapped down to that gap area, and then today bouncing off a bit off of that 58.50 low that we had on Friday. So overall, sort of trading inside the range of Friday's close, Friday's bar. So overall, I would say this is wait and see mode more than anything, sort of stalling out with the RSI almost dead neutral. For me, the line in the sand still is around that 5650 to 5700 level. A break below that would mean we break the 50-day moving average, we break the November and October lows, we break the breakout level from July and August, we break a 38.2% retracement level, which lines up very well with that early October low. So that range is really the level for me. As long as we hold that on pullbacks, I think conditions are pretty good. And that would be about a 5% sell-off from current levels, about a 6% drop from all-time highs there earlier in the month of November. If we don't break that, I think conditions are still okay. Currencies and commodities, we're looking at the dollar in the top panel, crude oil in the middle panel, gold in the bottom panel. Just want to note today we had the dollar dropping, you had crude oil rallying, and you had gold rallying. I wanted to point out that on the chart of crude oil, you actually have a bullish engulfing pattern as we test support. This is the crude oil future we're looking at, the continuous contract. So if you look at the September and October lows, and the lows we've been sort of trading down to over the last week or so have been all around $66, $67 a barrel. As of Friday, that's where we traded down to. Today, lower open, higher close. That's called a bullish engulfing pattern. Suggests short-term strength. We're saying the short-term tactical side, you look at 72. That's been resistance from late October, early November. We break above 72. That really opens the door to retest the October high around $78 a barrel. I would argue that's when energy starts to look like an interesting opportunity, at least as a trade. If crude oil is going to go from 70 up to 78 or 80, could be a nice bounce in energy stocks. And indeed, with today's bullish engulfing pattern, you see the energy sector as your top performer. Weaker dollar also opens the door for precious metals, which have been selling off in no small part due to the stronger dollar so far in the month of November. Weaker dollar means gold and silver can pop higher, which indeed they did. Looking at some individual stocks, Netflix also at the lower open, the higher close. Netflix making a new all-time high, and this is after the I don't know what sort of adjective I want to use to describe the Tyson Paul fight. Underwhelming maybe is one of them I would use, but despite that, talk about an incredibly successful marketing opportunity. Even though they had issues with the stream, we actually watched it. I watched it at home, did not have any issues with the stream personally, but I certainly saw a lot of chatter that There were issues, a lot of people getting, dropped from there. And what's interesting is, Netflix is queuing up to start showing NFL games. I think on Christmas Day, they're actually going to be hosting a couple NFL games. So, have a little bit of time to clean up the streaming issues that they experience. And I think it was a small percentage of viewers allegedly that experienced some real problems, but certainly an impressive marketing approach to the fight. All the lead up to it, the event was a little counterclimactic, anticlimactic, I would say, but Netflix overall getting rewarded, and the relative strength is, I think, what's the most important part of this chart. The fact that we're continually outperforming over the last 6 to 8 weeks by owning Netflix. That's kind of what you want to look for, particularly in this sort of environment where the market is unclear. Focus on stocks that are outperforming. Netflix is certainly one of them. NVIDIA reporting earnings on Wednesday. That is arguably the most important thing to watch this week. I would argue from a technical perspective, you have two things I would say to think about, right? I mean, number one, maybe three. Number one, the primary trend is up, right? We keep making higher highs and higher lows. And so if you're unsure about what might happen, I always go back to the basics. Would Charles Dow say this is an uptrend? And at this point, he would, by definition, because we're making higher highs and higher lows. That means as long as we hold 130 on pullbacks, which is this dashed red line, which also lines up with the 50-day moving average, as long as we would hold that, then that's true. If we would break 130, which is why that's where I would have an alert set right now, is if we break 130, NVIDIA is a dangerous chart. Now, second thing, maybe third thing I think now is the bearish divergence. Going into earnings, we have a bearish momentum divergence. Now, that's no guarantee that we're going to have a downside rotation, but a lot of major tops usually feature that particular pattern where the price is going higher on weaker momentum. So certainly something to watch as we get into earnings. Netflix made a new all-time high on Thursday of last week, just over 215. So that's a decent, continuation of this uptrend. Again, still making higher highs and higher lows. Friday, however, we grabbed lower. And today, instead of a bunch of buyers coming in and pushing us back up into Thursday's range, we actually traded a little bit lower. We didn't trade lower on an intraday basis, but we closed a little bit below Friday's close. So, I mean, you're certainly seeing a bit more distribution than I'd want to see on one of the biggest names here listed in the U.S. In terms of negative charts I could highlight for you, certainly healthcare stocks getting dinged pretty good post-election. A lot of these names are not really expected to thrive under a Trump administration as much as you might expect under a Harris win. So given the decisive victory and the mandate that we appear to have for a Trump presidency, certainly suggests a lot of healthcare names may be struggling here, along with renewable energy and other stocks have been struggling quite a bit. But I would argue the technical story on Eli Lilly has been underwhelming for quite some time. Note back here, July and August, right? We did not make a new high in August, attempting to make a new high and failing to do so. And not only that, it actually traded right around that resistance level for about 3 weeks. So we stalled out, and there were just a lack of willing buyers to push us above that resistance level, pushing above 1,000, which would be the level that would be sort of the next sort of big round number. Was not to be. We broke briefly below the 50-day moving average. The gap lower that you saw here in late October has now really followed through. Now we are making lower lows and lower highs. Now we are below both of the moving averages. The RSI is clearly in the bearish range. The relative strength is underperforming. I would argue that is a textbook bearish trend, the type of chart I happily avoid until signs of accumulation. Today, not happening, down another 2.5%. A couple other names reporting earnings this week to focus on, and these are both tomorrow. Big box retailers, Walmart coming out. Walmart is an exceptionally strong chart. You can see previous earning here in August had a nice gap higher, or previous earnings before that in May, nice gap higher. We've had a couple earnings releases in a row that have been pretty strongly rewarded to the upside and have continued this trend and allowed Walmart in each case to push to a new 52-week high. Do we get another one of those gaps higher? Overall, I'm inclined to assume a chart like this is innocent until proven guilty, but let's see what happens this week. Lowe's is another one. Now, not knowing earnings was coming up, I would tell you Lowe's is in a classic bullish setup, what we call a fat pitch chart, which is a strong long-term trend, a brief pullback to an ascending 50-day moving average. That's where a lot of pullbacks tend to build the next momentum for the next run higher. So, earnings coming up this week, I would say the technical setup is actually quite strong. That means key in, focus in on that October, November swing low around 260. You want to make sure that holds this week on any downside surprise for lows. Medtronic, maybe the last chart we will show here, and then we will wrap this episode. I'm actually showing the weekly chart of Medtronic. Now, Medtronic is in the healthcare sector, and again, one of the sectors struggling the most post-election. However, if you look at the weekly chart of Medtronic, it's actually quite constructive. This features what's called an inverted head and shoulders bottom. You might actually call this a complex inverse head and shoulders, where you have a low surrounded by higher lows, multiple shoulders on each side. In any case, we broke above that neckline, pulled back and tested the neckline as support. It's setting up for a really good upside surprise. However, they report earnings tomorrow. I think it's important to look at the technical configurations of charts like this going into earnings, just to get a sense of the sentiment and the momentum going into earnings. But remember, earnings can often be a binary outcome. Big winners, big losers tend to come out of that particular announcement. Folks, that's going to do it for our show today. Thanks for being flexible with me this week as I travel to New York. Should be on a normal schedule for at least the rest of the week, I believe. But I'll update you on social media if there's any change to that. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night.